It's July. Welcome to another Austin real estate market update. I'm David Shapiro with my co-host Lee Abraham. We run the Shapiro Group here in Austin, Texas, local real estate agents. Happy to chat with you about anything you have going on in your real estate world. And what we're here to do today, as we are every month, is talk about what's going on in the market, give you an update on the stats in real time. So if you're thinking about buying or you're thinking about selling, you know, is now the time? Should you wait? Should you move quickly? And so the best way to do that is to actually look at the stats. You can always find us back here at realestatevideohub.com. That's our YouTube channel, Living and Thriving in Austin, Texas. All right, we're starting off with an article. So Texas City leads the list of best summer destinations. And pretty amazing that Austin, in being a very hot city, is number 3 on the list of top summer travel destinations.
Well, you know, it's interesting, David. I spent a good part of my childhood in the beautiful state of Arizona, specifically Phoenix, where it gets real hot and gets pretty darn hot here in Austin too. So I agree, but it's just good to see these type of articles with Austin being a leader in something positive as the narrative continues to gain some momentum as to, you know, why the city really is a thriving metropolis, even in the heat of the summer.
Yeah, Arizona is a good example because sometimes I'll think like, is it just going to get too hot here in like 30 years? And then I think, well, Arizona is even hotter and people still live there, and actually way more. The Phoenix metro area is much bigger than the Austin metro area, one of the biggest cities in the country. So I don't think there's an issue there. And then, of course, this week, New York City was 101 degrees while Austin was 90. So you could have come to the South to get some relief from the heat because of the heat wave. So it's just hot everywhere in the summer. And I remember looking at this map of the country, and during these times, literally there's only a couple places you could go. There's the Colorado mountains where you have like Silverton, Aspen, those areas that stay cool, some areas in the mountains in Utah, and then the western coast in like the Northwest. But like most of the country is just hot. Well, that's how the summer is. Most of the world, for that matter, in the summer.
Since I've been championing Arizona, ironically, as hot as it is in the summers in Phoenix, the beautiful little pine tree mountain town of Prescott, Arizona, actually is beautiful. It's warm. Don't get me wrong. It's warm, maybe hot to some in the summer in Prescott, but that really is a great place to summer if you're using the season as a verb.
I would love to visit. So is it like Sedona?
Sedona is much more commercial, and Arizona is much more of a community, a lot of good people, good restaurants, beautiful place to be. It's the only city in Arizona that's built around a traditional town square that has the courthouse. They have art on the weekends, jazz in the evenings. It's just a fantastic location.
Nice. I look forward to visiting.
Yeah.
Here's a heat map, which I think is really interesting to look at. And you just see like, oh, you think, oh, you can go somewhere over here and get out of the heat. But no, it is just hot pretty much everywhere in the country. There's, you know, you can see in the mountain ranges here and in the Northwest, there's some relief and along the California coast. But even inland in California, it gets hot. This is, we're recording at 11 a.m. So it's only 9 a.m. here. So it's just not hot yet. But if we were to jump ahead to 1 p.m., wow, look at that. It's what a difference it makes going from night to day. So really just a few spots. Like here's those, not even all of Colorado, just in the mountains. You've got like Park City out here east of Salt Lake. You got the California mountains, the coast, obviously huge difference being right on the coast, being inland just a little bit, and then a little bit here in the Northwest. But it is hot pretty much everywhere in the country.
Mm-hmm.
And if you zoom out, you know, we know that there's a heat wave over here. I guess we have to go back in time so we can see it's hot there. Obviously north, not so hot, but a lot of the world in the summer is just very hot. That's my takeaway. And now some stats in the Austin real estate market. So we got number of active listings is climbing a little bit here from last month to this month, up to 3,300 active listings. And again, this is the city of Austin, single family homes. And what does that mean for us, Lee?
Well, if you take a look at the 3,348 active listings to start the month, we translate that supply side info with the demand side, how many homes are selling. And so we like to start with the 30-day pending numbers. That's the most current metric on sales velocity. And this number surprised me, David. I thought that we would see this number jump a bit as it did last month, but no, it's down 839 pending sales over the last 30 days. If you have 3,300 to sell and you're selling 800 a month, give or take, it's going to give you about a 4-month housing inventory. And so that's where we're sitting right now, maybe just shy of a 4-month housing inventory, technically a seller's market. Last month, we talked about how that may not feel like a seller's market to some sellers, but those are the numbers we're reporting. Again, a little bit surprised at the relative low number on the pending sales.
And it is hyper local, like we've mentioned many times before. So 4 is the average. There's parts of town and little neighborhoods or condo communities, and we've had some experience in different neighborhoods in the last couple months here where things have sold really quickly. There's not enough supply, and so that's where it's hyper local. Meanwhile, we're having conversations with sellers. We're like, hey, your area, there's actually too much supply, and if you don't need to sell, you should wait. And so we're having both those conversations with sellers right now. So if you want to know what it is for your specific neighborhood or even just condo community, reach out. We'd love to have a conversation and walk you through the stats in there. And here's what that looks like over time. So climbing from the lows just a couple months ago, under 3 months, up to 4 months. And we'll see, will we hit the 5 months of housing inventory that we've been peaking at every year for the last 4 years?
Yeah, well, the interesting part will be the timing of the peak as well, not just where it caps, but when. And so it seems like a little bit more of a moving target in the post-COVID era. But yeah, we'll see.
Mm-hmm. Yeah, you can see a couple years ago in July, we were only at 3.5 months and we hit almost 5 in November. Whereas 2 years ago, we were at 5 in August. And then last year it was June, we were at 5. So yeah, it's a moving target.
Right.
Number of sales per month up year over year, 5%, down month over month. And do we have the 10-year? Here we go. Here's what it looks like over 10 years. Thoughts on this, Lee?
It's up a little bit, I guess. Well, I'm just trying to interpret the last data point there. So it seems like that we're climbing a bit just over, kind of reversing a trend over the prior 3 years where the peak was kind of dropping. Now we're back up. In context of the 10-year span, David, obviously there's a lot of room for growth in terms of sales volumes, units sold, and that kind of ties into the pent-up demand. So I kind of look at it that way, is that it's almost like waves in a pool or the ocean there, and pretty soon there's going to be a big wave of demand that's going to hit, kind of what that looks like to me. And golly, how about this? Another record-setting price point, barely, but the highest recorded average sale price in the month of June. And I'll bet you're asking, well, what does that mean on the median price? Let's take a look.
So 685 was the record. So we're still below that, 35K below. If I were to do some quick math on that, that's all right. So we got 35K below the previously 685. So that's about 5% off the all-time high. Yeah. So that's pretty interesting. Well, actually, no, the all-time high was July of 2022 for the median. But either way, the all-time high was May of 2022 on the median, but we're 5% below the June price.
Right. So, I mean, to me, and my bias is well documented across the internet against the median. However, comparing it and looking at it relative to the average can be interesting. And so I haven't thought this through at all, but like, why is, the average a record and not the median? What's that really telling us? And, that kind of a thing. So it's a little interesting, but I gravitate towards relying on the average figures for making sense of the market.
Well, we know that the luxury market is more robust right now than the middle of market. So
up to a point though, but let's even chat about that, because we know, for example, taking a look at some of the submarkets we've been working on, particularly in the Lake Austin area, which is one of the premium luxury submarkets in Austin, it's been soft. Mm-hmm. So even the luxury market is segmented, but I agree that the pull of the luxury market brings the number up.
Yeah. My take is it's schools. People continue to pay up for good school districts.
Right.
Westlake is the best school district. It's also one of the priciest neighborhoods. And so, it's just those people are doing well. The stock market is doing phenomenal. It's their kids. They'll spend anything for them. And we've seen that even with people that maybe aren't, in the $5 million purchase bracket, but they're like, look, they're my kids. This is a stretch for us to make the move. We're going to go and spend the extra $500,000 million to get into the right school district. Mm-hmm. So it is interesting. And the bottom line is we're not that far, no matter how you look at it, under all-time highs. Like the way, however you cut it, it's 15% below is kind of like the max on average, right? Whether you're looking at the median or the average, but on average. So that means some people are at right where it was all-time highs. Some people are, further below that 15%. And when you look at, do we have this chart? I think these two charts are awesome to see because unless you bought your property right here in this little peak period in 2021 or 2022, you should be at break even or have equity, right? That's the median. If we go back one, here's the average. Do you have a different takeaway from this?
No, they basically tell the same story from that standpoint.
Yeah. Anything else on these before we move on?
No, just good data visualization and helps us make sense of what's going on right now, which is days to sell. So last month, this was the one I was really looking at. Days to sell last couple years has gone up from the May to June reporting. And I was hoping to see this drop as it did ever so slightly. That's a little contrary to a couple of the other numbers, which are not as encouraging, but this in particular, I'm happy to see. And I do think that it addresses the homes that have been hitting the market lately, which may be a cut above the ones that have been stale on the market, prepared better strategy, better planning, better home preparation, and are selling quickly. And that's been our experience on both the listing and the buying side, David. So I'm happy to see this number.
Okay, good. And here it is over time. Crazy what it dropped to in 2021. So, and a little bit above what we were prior to the pandemic.
Right.
New listings up 5% year over year, down month to month. And I think over time, it's a little bit harder to tell here. What's your takeaway?
Well, we talked about this one, looking at that 10-year view now for a couple months now. Basically, this looks like stability, but my take is that stability would look like it going up. And the fact that it's not going up is a sign of, a weakened sales volume environment. Mm-hmm. So it looks like stability, but it should be going up to really reflect stability.
Yeah, I mean, it's a two-sided thing. You got sellers who don't want to list. You got buyers who are hesitant to buy. That's why the number of transactions are down, both for basically the same reason, which is interest rate. If you're a seller and you have a 3% interest rate, you don't want to sell. If you're a buyer and you're facing a 6%, 7% interest rate, you're hesitant to buy. So as that has been the key, what we've talked about. If that interest rate comes down and people can buy for less, they can get out of their house knowing, okay, I'm giving up my 3% mortgage, but I'm not going to pay double. I'm only going to pay 50% more. It starts to be easier for them to do the mental gymnastics to justify that.
Right. One thing that we haven't talked about, David, and we will talk about the mortgage rates here in a minute, but just kind of thinking about it for the first time from this perspective, which is it's kind of nice and energizing to be on the razor's edge of focal point of an interest rate. And so it's exciting. The market can change quickly. Just, back when I started in real estate, interest rates were 17, 18%. And so, golly, even if they got dropped by, 30%, it's not going to make that much of a difference, And so that doom and gloom of true high interest rates is a very different thing than what we're at now. We're kind of in an energized state. Everybody's wired up for information. What's the Fed going to do? What's this? What's that? And expectations are more than ever driving our market. So I'll take one step further, which is at some point, rates are going to come down. And when that happens, prices are going to jump. That may not be headline news or shocking, but it's pretty much guarantee if ever there was one on everything that we've looked at. So what does that mean? It's a good time to invest.
You're saying it's a guarantee that rates come down.
At some point, rates are going to come down.
I do think it's interesting, the line of thinking, we'll never see 3% mortgage rates again. And I remember thinking that in 2012 12 when I bought a property and I got a 3% mortgage rate. I'm like, oh, I'm going to keep this forever. I'm never going to see this rate again. Well, then we saw those again in 2020. So, I think people tend to forget how bad
Right.
humans are at cycles. And I see it again now with the AI CapEx spending. Like at some point, we're going to overdo it and there's going to be a correction. And you don't know if that's going to be in 6 months or is it going to be in 6 years? It's really hard to know. But we tend to always do it. And then when that happens, the Fed reacts by lowering rates to support whatever's crashing. So it will probably come, whether, it happens in the next year. That would be great, but probably not. So to any large extent. But, there might be a small drop in rates. And I think we're at a point where 0.5% is going to
That's
make a difference.
that's my point, is that we're in a market where even marginal adjustments impact the volume, and that's an exciting place to be, as opposed to other markets where it just really was a far goal to move the market with an interest rate because there was just so much ground to make up.
Are you saying that when the rates were 16%, what if you dropped them to 12, it didn't make a difference?
From 16 to 12 made a difference. I bought my first house when rates dropped to 12%, and it did make a difference, but not the kind of difference that we're going to see if we go sub 6 here in Austin.
Can you expand on that? Because why would that? It would seem that, so if we're at 6 now and we drop 30%, that's 1.8 points. So that's pretty significant. I think we'd see some huge. So you're saying basically 30% now is way more meaningful than 30%
Right.
in the 80s.
Very much so. Just because of the differential between the relative affordability of the interest rate. I mean, we're talking about the era when seller carrybacks and all-inclusive trust deeds and wraparounds and all that came about because it was just impossible to borrow and make sense of things. So even if you had a drop of 2 points on the percentage, it wasn't really going to significantly impact. 16 to 12 for sure. 12 to 10, 10 to 8, those are all significant brackets that really had a measurable impact. The other dynamic in our specific situation is the pent-up demand, which we didn't have back at that time. We had pent-up supply. We had the glut of supply, which is an extremely different dynamic than what we have now. So even the lower, more affordable interest rate, the main difference in my view is that Austin has clear pent-up demand. You did a great video on it, if trend lines don't lie. And it was very different back in, the 80s, early 80s, when we had, 18, 17% rates on loans. There was a glut of properties, a huge oversupply, average values dropping month over month. If appraisers, which is what I was doing back then, was doing an appraisal and you had a comp from 3 months ago, you were subtracting the market conditions from the price because it was worth less now than it was 3 months ago when it sold. So interest rate reductions back at that time helped, but they were not nearly as dramatic. Also, as we just think about it, country wasn't wired up for information. That, if I'm not mistaken, was kind of like pre-internet. We didn't have all kinds of daily, week, monthly, up to the minute reports on what was going on or going to happen tomorrow.
You said something that sounds very important, which is that 3 months later doing an appraisal, you'd actually subtract because the property was worth less than it was 3 months ago. And that was just a known thing.
Yup.
So can you imagine going in as a buyer and you're just thinking, well, we know this is going to be worth less than 3 months, but we got to get the price lower.
Right. No, I'm telling you, that was a gut-wrenching time to be in the business.
Yeah. I mean, that's not what we're dealing with now. People are not looking at these homes going, it's going to be worth less than in 6 months or a year. They're looking at it going like, okay, it'll probably be worth the same. Maybe it'll start to go up a little bit. So we're in a much different environment, much more confidence that buyers should have buying. Yeah. And, we work with some investors, some that are buying, quite a few homes every month. And they're looking at this going like, this is a life, a once in a decade, maybe once in a lifetime opportunity that we haven't had since 2012, 2011 to start buying up homes at a price that we're not going to see maybe again in our lifetime. Right. If you had bought homes between 2011 and 2015, and we could go back to the chart, those were prices that we will never see again. Right. Here's the median sale price going back to 2016. We will never see that price again. 2016 prices. It doesn't matter if you do median or average, but those are prices that we are never going to see again. And take this chart and just move it over this price that we're seeing now. It's pretty unlikely that we're going to ever see these prices again once we get a couple years out from now.
Right.
And so the investors that we're working with that have lots of history and experience, that's what they're seeing, and they're going in hard. It's interesting. It's much different than the one-off landlord where there's capitulation. They're like, look, you know what? I don't want to deal with this anymore. Like, I'm done. Let me sell this thing. I'd rather just put the money in the stock market.
Right.
You see the stock market's been going gangbusters over the last couple of years. Meanwhile, you're dealing with headaches with tenants and values aren't going up. You're not even making that much off rent. It's a logical decision to make, but it's if you look back, you kind of have to go with the things that aren't in favor. Right now, real estate not in favor, stock market in favor. If you had made that reverse decision in 2022 and been like, man, real estate's really in favor, stock market's getting beaten up, maybe I should switch those, it would have been a huge, lifetime trade to make that decision. So maybe we're in that reverse. Stock market's up, real estate down. Maybe it's time to start taking some money off the table in the stock market and putting it back into real estate.
That'd be an interesting title for a book, Money Off the Table, a contrarian strategy to wealth creation. The one thing that I was going to say, David, in response to the focus on a buyer buying, believing that the home is going to be worth less in a few months than when they're buying it. Mm-hmm. When you really dig into that, obviously there's an underlying sentiment of optimism that downward trend is going to turn around here before too long. And so all of those buyers are not buying with the expectation that it's always going to keep going down. They're aware that it's been going down recently, may continue for a little while, but ultimately it's got to go up. And that's that beginning of the narrative, again, prior to the internet. That's the beginning of that narrative that kind of formed organically as rates did come down and, people did get back into the market, price started to go up, becomes a self-fulfilling prophecy either way. So just interesting dynamic on how people react. We're in a good spot though. I'm very optimistic that at some point things are going to pop here from a volume standpoint.
Yeah. As an investor, it's important to keep in mind that you're never going to hit the bottom of the market. So hard, right? You try to buy close to the bottom, but if it goes down a little bit after somebody buys, it's okay. But yeah, like you said, the anticipation is that it's going back up sooner. Should we talk about sales price to list price ratio?
Right. Yeah. So this stat, I was disappointed, and it kind of is contrary to my sort of bullish forecast driven by the days on market. And I was hoping that this would conspire to continue to go up, but it did go up a little year over year. I was looking for a month to month increase. So I was a little bit disappointed by this. It kind of tempers my optimism on how strong the second half of the year is going to be.
Okay. Well, there you can see it over 10 years. And our listing inventory barometer. So this is the most real-time stat. What are we seeing, Lee?
Well, the thing that I do like is the inventory ratio continuing to be well above 100%. We need to have more good listings on the market. It's going to work in everybody's favor. So as long as this is over 100%, it means that there were more new listings at the end of the week than those that had sold. But when you look all the way over to the right, it's a little bit less of a slower pace. We did actually have a week, the 14th through the 20th, where because of withdrawn and expired listings, there were actually 18 fewer listings at the end of the week than at the beginning of the week. So this is just telling us, regardless of if it's through pending sales or expired withdrawns, that the inventory is growing a little bit. My takeaway is I'd like to see it growing a little bit more for the next month or two so that we can give our buyers more choices.
And here you can see that over time. So mostly here, the inventory has been growing. And then these areas, you can see the inventory was declining. But that's how we end up with this balance, is that, it's pretty equilibrium over time. And then this one's interesting. So we've been looking at this one every month, and you can see the new listings in blue, the pending sales in red. And I guess this was that week you were talking about, where we actually saw, you can see those lines touch the cost a little bit. But what we were expecting was something like this, where there's a closer gap, but that there are still more listings than pendings. It's kind of an interesting one because the gap closed there Wasn't expecting that, but should see something like this one of these 2 years.
Yeah, and I think it just is a visual representation of the the harmonious flow, basically, for lack of a better way of saying it, between the supply and the demand. They both have been in tandem, and seems more so than ever, moving up and down, which is good for equity, good for values. So yeah, we'll keep an eye on this as well. But the pending sales was disappointed. So the last data point, David, where it dropped in the final week reported as a downward trend line. If I was hoping to see that go up. And so it's going to be interesting to see the first few weeks in our next report, because I've got to believe those are going to go up. And when you take a look at the peak for the past several years, are we going to exceed the peak, for pending sales? Pending sales is the main thing right now. So,
I mean, certainly we've exceeded the peak of the last 2 years.
Right.
And we're maybe slightly above 3 years ago. Can we hit 4 years ago? We're probably in line with that.
Yeah. So just as we were looking at the 10-year chart, we can kind of forecast this out. This is, 4 or 5 year span here. At some point, all of these peaks and all of these valleys are going to be at a higher floor and ceiling. That's another way to kind of think about this.
Mm-hmm.
We've kind of locked into a zone here. This zone's going to be going up over the next 5 years.
Yeah. Higher highs, higher lows.
Right.
And interestingly, we haven't hit the peak of the new listings. We have exceeded the peak of the pendings. So that's why we see inventory is tighter right now than it has been at this time in years past.
Correct.
Mortgage rates. All right. The metric that probably moves things the most. Here it is, sitting right basically in the middle of what it's been, the 52-week range. And do we have we don't have the chart of it, but we've talked about this on last videos, what this looks like over time. And in February, when this thing was coming down, it looked like we were heading in the right direction. The Iran war broke out, but it hasn't changed since then. There's still inflation worries. So we'll see what happens over the coming months, but would love to see this come down.
Yeah, we're in striking distance of significant shift, and we'll see if it actually happens. But we're kind of in the middle, David. Of the
when it actually happens, it'll happen. Not if, when it actually happens.
Yeah, I guess I was thinking of if in terms of the next 2 quarters, just kind of forecasting. But yeah, at some point, as we agree, it'll happen.
Yeah. Anything else you want to chat about?
No, I mean, from the weather to schools to real estate values in your neighborhood, we covered quite a bit. We appreciate everybody consumes these monthly reports, and we're here for you. So let us know if you're looking to buy, sell, or invest. We'll dig into the details and try to work your best angles for you.
Cool. All right. Well, thanks for joining us, everybody. If you got a lot out of this, please share it with a friend, and we look forward to seeing you next month.
Thanks, everybody.